Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. I trust you're having a wonderful day. Enjoyed your weekend, and it's an exciting week ahead in markets, most definitely. There's going to be a lot of Fed members speaking. Of course, we'll get the usual volatility around that, where the intraday traders take advantage of the opportunity to push the market one way and then the other way and then the other way and then the other way before they're finished setting off pretty much everyone else's stops. And of course, the price makers have nothing to do with that, the major price makers in New York. So there will be moments of volatility in this week ahead, but we're starting the week with the full knowledge that, yay, our re-acceleration of inflation scenario, which stood alone out there in the wilderness of the economic community, is definitely, most assuredly happening, confirmed by data. PCE core in the US on Friday up 0.6%, which is a big number for that series. And it's the second month of acceleration, actually. So core PCE inflation accelerated from 0.2% to 0.4% the previous month, and now from 0.4 to 0.6%. And the core number and you've got to remember that core number doesn't include gasoline prices. So there's a lot more pipeline pressure in the economy than that number would suggest. And that is going to terrify the Federal Reserve, that they should not have dropped from 50 to 25 points. And now they'll just have to keep ratcheting up at 25 points ad infinitum, instead of doing a few 50s and getting it out of the way. We're looking at, I've been saying 4 to 8, but it's starting to look more like 6 to 12 more Fed hikes. But we'll stick with the 4 to 8 forecast at the moment, because we're ahead of the market on that, and we may as well stick with that and be seen to be winners for a moment. But I do want to emphasize that the Fed's going to be hiking interest rates for a very long time. And one of their favored number two, the through-year average, moved up to 4.7%, which was way ahead of what the market was expecting, 4.3. And if it had come in at 4.3, people still will have been seriously concerned, but it's come in at 4.7. It comes in on top of the producer prices inflation and the real inflation numbers. So we're seeing re-acceleration of inflation across the board, even when gasoline prices are not included. So a horrific inflation outlook. And I said in a commentary today, inflation is winning the battle with the Fed. The Fed is trying to hit inflation down, but inflation's coming back in their face despite all of the aggressive interest rate hikes already done. And that's the key thing to consider here economically and fundamentally. It means that the Fed will be hiking, that it will continue to drive demand lower, that it will continue to seek to really stop this inflation wave in its tracks, and it's unlikely to be able to do so. So I think, we've had a 5.75 to 6.5% terminal target range when everyone else was at 3.5%, 4%. And now some of the senior economists in the United States are now joining our view and saying, yes, it's probably going to 6.3 or 6.5 as a terminal Fed funds rate. Now, most of the market hasn't caught up with that, but the people saying that are some of the more sort of cutting edge top economists in the United States. They're about 6 months behind us, but they are catching up. And so will market sentiment slowly as those sort of thought leaders, to use that term, those ideas trickle down into some of the more mainstream commentaries, which always play safe and wait for someone else to have said it, whereas we don't. So 5.75 to 6.5% was always my target range, with risk always emphasized to 7.5% as a Fed terminal rate. And I've been quoted in the media saying that for many months now, and it seemed like this extreme case. Now it's moving to where our 5.75 to 6.5 is more of a central case. Whereas even that was considered a risk scenario for most people. It's becoming a more accepted central case in economic thought around the world, and particularly in the United States. So therefore, our risk scenario of 7.5% is now well and truly on the horizon. Other data we saw out in the US on Friday included consumer spending, which came out with a whopping 1.8%, which of course the market took as a negative because it means the Fed has carte blanche to keep raising interest rates, which of course it does. But the number wasn't even really that good. If you took out price changes, it was 1.1%, and the previous number was a decline. So yes, it's had a spike, but I do think, as we've seen with other data, that spike is due to people in December, in the seasonal, usually big spending period, retail sales spending was down. They waited until the post-season sales and then they went out and grabbed opportunities. So that's what we've seen, this fluctuation and a bit of a spike in some consumer data in the month of January for the United States. But I see it as a snowflake, as I said in the written piece today, that really it's like a snowflake in the Arizona desert. Gone. So, I'm not at all on board with the idea that the US economy is going to do anything other than stall under the weight of continuing Fed rate hikes. Thanks very much. I need a glass of water, but I'm at the end, so I'm going to finish here. What does it mean for markets? See if I can get this out before reaching for the water. What it means for market is obviously I just alluded to. Stocks continue to go lower. Because they're overpriced for the reality that's on the ground in Main Street America in any case. And the US dollar could have a tear higher. People are trying to sort of sell this US dollar rally, but I'd be very careful about doing so. I think the idea that the Fed's just going to keep hiking is going to scare a lot of US dollar shorts out of the market that have already been scared out. But I think there's more still waiting who had, if you like, deeper pain thresholds, and they're going to start to get worn out too soon. So, positive the US dollar until eventually the US dollar bubble bursts in a big way. But what we saw in the previous months was not the big US dollar burst, but it could have been a prelude, but it was not the big US dollar burst. At some point, the US dollar collapses 10, 25%, but we're not at that point yet, and we could have a tear higher still for the US dollar, which means Euro and Australian dollar are likely to remain under a lot of pressure. In Australia today, we had fourth quarter profits, got my voice back, fourth quarter profits, which were very strong, strongest in 2.5 years. So it's good. But is there a link between corporate profits and inflation? Of course there is. I argued from 18 months ago that inflation is also being driven by increased profit margins using the cover story of COVID. So basically you could raise prices without losing market share for the first time in 20 years around the world, and Australian companies and businesses were certainly actively doing that, getting their profit margins built wide, and with some justification because of the heightened uncertainty, but they've maintained that and continue to build those profit margins, which is why fourth quarter profits, corporate profits looked good today. But that number really confirms that inflation in Australia is going to be resilient, and the RBA too is going to be hiking interest rates for a very long time. This won't support the Australian dollar because the yield difference with the US dollar will be maintained. Thanks very much. Have a good day. Clifford Bennett, Chief Economist, ACY Securities.